Hi, my name is Jack Matson, and today I'm giving my leveraged buyout model presentation. I was not able to present on the original assigned date or my makeup date due to a baseball traveling schedule conflict, which was really tough, and then I fell ill on my most recent presentation date. Thank you, and I hope you enjoy the presentation. What is a leveraged buyout model? So the overview, it demonstrates what happens when a private equity company acquires another company through a combination of equity and debt. And typically, the big difference for a leveraged buyout model is that they sell the company within 3 to 5 years of acquisition. LBOs, they aim for a 20 to 25% return on their investment, and that is historically much higher than the return in the stock market. And it is assumed that the buyer will sell the investment in the future. How it works, the transition consists of two parts, and that is similar to buying a house. You could think of it in another aspect. There's the down payment, where equity equals cash. And then you have the mortgage, which is the debt, in terms of if you're putting it in the light of buying a house. And using more debt will mean that you'll have a higher return, which we'll discuss in future slides. But the main concept of that is when you're looking at your return, if you're having a positive return, the effects are going to be greater. But if it's a failed project, then your risk and the consequences will be greater because you're having more margin. So how it works, the companies repay debt over time, and that increases the PE's return. And the big reason is because more debt equals a higher return. If you're having positive returns, then the debt's going to add to your return, and when you divide that by your initial investment, the initial investment is going to be smaller, which is going to boost the return because you borrowed more than your actual cash that you gave. So the money today is also worth more than money tomorrow. That's just the basic, take your dollar today, the present value of cash flows, and divide it by the 1 plus the discount rate. That's what we learned in class, and so that's why more money today is worth more than tomorrow. And also, it's easier to earn a high return on a smaller amount of money. And those are the two reasons why that LBOs use so much debt, and their return is 20 to 25%, which is higher than the standard stock market return. There's an 8-step process for an LBO model: determine, price and amounts, assign, create, build, which we'll talk about how you start incorporating Excel. Calculate the cash available and debt repayment also using Excel, and then we complete debt schedules, link them, and then we calculate the return to investors and sensitivity tables. Step 1 is determine the price, debt, and equity required. PE firms focus on how price affects return. We look at past projects, and that's a big consistency throughout this presentation, is looking at projects that have been successful, that are similar, and that's how we get our proportions. That's a continuing theme that you'll see throughout this. And also, it's important to include in debt advisory fees and financing fees, but also legal fees, which is not included in this. Step 2 is assign. We're going to assign the percentage totals and IR. It's important to note high yield debts have higher IR, and the IR is usually fixed, but the bank debt is floating, and bank debt is amortized, and so that's principal paid off over time. Step 2 is how to determine bank debt and high yield debt. So we're going to look at recent similar LBO transactions, as I mentioned in 2 previous steps, and then you're going to calculate your interest and principal repayment obligations based on successful previous LBO models. And then you're going to use numbers suggested by the leverage finance / DCM groups and other lenders. There are websites that have the proportions that they recommend based off similar successful projects and just based on the current economic state and projected economic growth, inflation. A lot of different things go into how you're going to divide up your equity and your debt. Step 3 is we're going to create sources and uses. The purpose is to track certain funds, and sources are going to be debt and preferred stock, investor equity, and then excess cash flow from the target. Then uses are going to be the equity value of the company, advisory, financing, and legal fees, which I discussed at the beginning, and then we're going to have refinance debt, which we'll talk about in a few more slides. And then we need to understand how much cash the PE firm must put out in order to get our proportions and create our projections based on the LBO and what we're acquiring. Step 4 is going to be construct the income statement. You're putting your inputs based around recent historical growth patterns in revenue, expense, and other items. This is to calculate the free cash flow in the next step. There's a couple formulas for free cash flow, and we will be using free cash flow in our Excel to figure out future things, which we'll discuss. And then interest and income expense are not used in this step because we use them when we're calculating the debt schedule in a later step. Step 5 is calculate the free cash flow. This is determine how much cash actually has to be repaid. It's levered because it does not include the interest, income, or expense interest. In FCF free cash flow, it's subtracting capital expenditures from cash flow from operations. Right here we can see FCF equals cash flow of operations minus cap expenses. And then beginning cash flow plus free cash flow minus the minimum cash balance is going to be our CADR, which is cash available for debt repayment. And that's going to be used to find the beginning cash balance. Step 6 is building the debt schedule. For debt, there's various different maturities, yields, and terms that we have to deal with because we're looking at a 3 to 5 year finance project and a lot of equity and debt, especially debt because of how we discussed for the increased returns. So the debt schedule is important because it's going to know who and how and when to be paid, and it's useful in determining the interest expense proportion and income statement in the following steps. Step 7 is going to be to link the income statement. So this is when we start to get into the Excel portion, and it's going to be very visual. I'm sorry if on this it's going to be tough to see, but you do not have to. So for the Excel, you will be typing in all of your information, your proportions, which we'll get to. But then when you run your calculations, you have to make sure that you have enable iterative calculations checked, or you will run into problems in the future when you're linking your income statement with your cash flows. And it will give you an error message, which will derail you, and you'll be curious, why is this not working? Well, it's because you have to make sure you have enable iterative calculations checked. Then this is what you should get. It'll be tough to see, but this is kind of just an example of what one of the linked income statements look like. You have your subtracted debts, you have your different cash flows, operating expenses, and then you have your 3 categories: your pre-tax income, operating expense, revenue. Just a standardized income statement. And when we're linking it, we're using these formulas for cash flows. Cash for debt repayments, you're going to add the mandatory and optional debt repayments from the debt schedule. Beginning cash balance, you're going to link the ending cash balance for each year, and you're going to continue to accumulate that. So it's going to be from the previous year to the ending year each year. Then net change in cash flow, it's going to be the free cash flow minus the cash flow used for the debt repayment. And ending cash balance is going to be the sum of the beginning cash flow and the net change in cash. And this is what we get when we do that. Kind of a final for the linked cash flows. Same left-hand side, net income, cash flow from operations. And then we see how much this has changed. Push this over, and we have our subtracted and additions right there. Step 8 is going to be investor returns and the sensitivity tables. We will use the IRR function in Excel to enter the appropriate information. It's important that enterprise value equals earnings before income tax minus that times the multiple. Investor equity equals enterprise value plus cash minus the remaining outstanding debt. That's one that just kind of a basic formula because we're looking at our equity. It's going to be the value of the cash, the assets, minus the remaining debt. And this is what it's going to look like when you calculate that in Excel. Here we have all of our, what we just talked about, investor equity, earnings for income tax, debt, multiple, the value, investor equity, and then our IRR in the example is 16.7%. And here's the sensitivity tables. In Excel, you go in, you create your sensitivity tables using sensitivity analysis, and this is an example of what we have. As you can see, pretty standard. That does not require too much work when you're doing it, just going out of this Excel functions. Now we have rules of thumb. We have a few, and they're just facts about LBOs and how they work. First is, what is an ideal candidate for an LBO? It's going to be stable cash flows, undervalued, and low risk are the three big ones, just because it's such a big investment. You want low risk. You don't want to default, because even though your return is magnified and it's going to be on average much higher than the stock market, if you incorporate risk and fail, the losses are going to be much more extreme and magnified as well. And then undervalued, because you're purchasing a company, you want to be able to know that you're going to be able to turn it around and increase its value. And then you want a strong management team and a solid base of assets. How can a PE boost IRR if return is low? Reduce purchase price, increase exit multiple, as we looked in the formula from a few previous slides ago. That's one of the factors in there. Increase debt used. There's a point where there's too much debt, obviously, but like we discussed at the beginning, more debt equals a higher return. And so it's important to just understand that and maximize the debt and use that almost as your own asset and increase your value. And then increase margins by reducing expenses. Another rule of thumb is, can you tell what the returns will be without completing a full LBO model? And yes, you can by using a 5-year model. If PE doubles its money in 5 years, that's a 15% IRR. If PE triples in 5 years under the 5-year model that you use, that's going to be a 25% IRR. That's just a good rule of thumb if you don't want to go through the entire process that we've discussed. And then how could you use an LBO model to value a company? Well, you set your target goal for IRR, then back solving using Excel, which we have just gone over, all the basic functions of Excel, and you figure out the maximum you can spend to reach that target goal. And then you're going to kind of have an idea for your proportions and how you're going to be able to value this company based on what can you put in and what can you get out. Rule of thumb, why would a PE firm prefer to use as much debt as possible in an LBO? Well, the firm does not plan to hold the company for too long. As we discussed, it's a 3 to 5 year investment, so the debt is owned by the company. They assume most of the risk. And that is the end of the presentation. Thank you very much for listening, and I appreciate all that you've done for me this semester in giving me these chances due to just the rigorous schedule and tough circumstances I've been put in. I appreciate it greatly. Thank you very much.